Dividend stock investing. I'm going to share with you today how to completely live off of dividend stocks. Completely. Dividend checks, massive dividend checks, how those can be used to completely cover all living expenses. I'm going to share an extensive Excel model that I prepared, and you can follow along at home. I'm going to link to this model in the description below and also in the pinned comment, so make sure to follow along at home. And also in today's video, I have a bonus segment. I was out today. Some of my subscribers were asking, Ian, can you do a video about the day, a day in your life? And so I decided to do that today. And so after I talk about completely living off of dividend checks, massive passive income, I will transition into the second segment in today's video, which is a day in my life. Get ready, everyone. Really exciting video today. All right, so segment number one. This one was inspired by my man Drifter77, and I've been receiving a lot of questions as always, and to celebrate 60,000 dividend investors strong, thank you everyone for subscribing. I'm answering questions, and so today's video is actually inspired by Drifter, and so I'm going to pop his question on the screen right now. Check it out. And he says, my dad is going to be investing $50,000 a year. He's going to do it on a consistent basis in dividend stocks, and he's also going to be adding DRIP. What that means is during these years where he's building his stock portfolio, he will be reinvesting the dividends back into the stocks that paid the dividends. He's going to be dripping, in other words, the dividends. And then the question goes on to say, will he be able to retire in 17 years? He wants to retire at 60 and make just as much money as he's making right now. And so it's hard to completely answer this question because I don't know how much money Drifter's dad makes right now. And so that is an unknown. And I have to make an assumption as well. I'm assuming here, because this channel is about dividend stocks and buy and hold forever, I don't sell, that Drifter is making the assumption that his dad will build up this portfolio, and when he's 60, he'll live off of the dividends, but he doesn't want to touch the actual equity. He doesn't want to sell stocks. So I'm making that assumption. And so thankfully, I already have an Excel model that I was able to basically build off of to answer this question. So I'm really excited to do this today. And if you've been following my videos for a while, I'll link in the description below. I had a video before where I discussed the miracle of compound interest and that miracle with dividends reinvested. And so that's how I was able to answer the question. So I want to share on the screen right now my Excel model. So check it out. And the first thing that I'm sharing, it's actually a little bit of repeat. This is repeat to the video I'm linking to in the description below. And it just gives a refresher because I build my response to Drifter's question off of this. And so basically, if you remember, it's funny, when I did this video, it was, the example I used was 3M. And at the time, 3M was trading in the $160 range. And it's so funny. Right now, 3M is trading in that range yet again. And so this model was a perfect basis. But basically, to be able to retire and live off of dividends as soon as possible, I generally look for stocks like 3M that have a reasonably good starting yield and a reasonably good dividend growth rate. Those two combined is kind of that sweet spot. You see that with a few other stocks these days. I would say AbbVie is a good example. It has a great starting yield, great dividend growth rate. And also Altria is another example of that. Again, high starting yield, high dividend growth rate. When you combine those two factors, it is the quickest way generally to retire off of dividends. And so to answer this question, I wanted to use 3M as a proxy, but obviously the portfolio that would be built would be a composition of stocks like 3M, and some may yield more, some may yield less, but I'm assuming overall the average starting yield is somewhere in the 3.5% range, and I'm assuming that the overall rate of growth of the dividend is somewhere in the 7% range. And so with what I'm sharing on the screen right now, 3M, actually, the 5-year compound annual growth rate has been 7.5% on the dividend. And so I'm assuming here that the dividend will continue to grow in perpetuity at roughly 7% per year. And I am assuming also capital appreciation. The stock increases at a similar clip, about 7% per year. And so what you see on the screen now is just the basic model. I'm just going to do real quick here because this was discussed before in the video I'm going to link to in the description below. But I just assume if I start with one share, the share is priced where it currently is, which is $166.87. And I just let that accumulate over the years. What happens? What will happen to my investment? And so what you see here is each year I get a dividend, and that dividend grows over time. And what I'm doing is I'm actually reinvesting the dividend each year. So in year one, I make $5.88. My assumption here is in year one, the average share price is this $166.87. And so I buy $5.88 worth of stock at that price. And so in year two, that's why I have 1.04 shares. It's not one share anymore. I bought 0.04 shares with my reinvested dividend. You also see in year two that the share price has gone up. It's gone up by 7%. Why? Because stocks don't typically have a constant share price over time. They go up. And to be fair in the model here, the stock price, it has to go up because when the dividends reinvest in future years, I'm reinvesting at higher and higher prices. And so actually having the share price go up here makes the model more realistic. And so year two, I have 1.04 shares. The dividend per share goes up. It's increased from $5.88 a share, which is the current dividend rate. And it increases to 6.29 because it goes up by 7%. And so my dividend income in year two is $6.51. I buy $6.51 worth of 3M in year two at $178.55. And so in year three, I have 1.07 shares. If I keep doing this basically for 17 years, at the end of year 17, I end up having nearly 2 shares. I have 1.74 shares because I've been reinvesting my dividends all those years. Dividends have been growing, and share price goes up to $492 because the share price has been growing by 7% per year. And the dividends per share per year have gone up to $17.36. And so basically my dividend income in year 17 is $30 and change. My yield on cost is quite high at 18%. And I get that 18% by taking my $30.21 and dividing by my purchase price, which is the share price in year one, which is $166.87. This right here, quite frankly, is the miracle of compound interest. It's the miracle of reinvesting dividends. It is the long-term approach. You can see that the yield on cost first few years, not very exciting, but after 17 years, it's quite exciting. For every $100 invested, the investor gets $18 a year in cash flow, and that continues to grow in year 18 and so on and so forth. And what's so interesting here is the total returns. And so the total returns are basically a function of the total dollar value that occurs. And so in year one, these are actually some new columns that I didn't share before. I'm talking about columns G and H right now. Dollar value in year one is just $166.87. That was the cost of one share in year one. But literally, if I don't reinvest any net new capital, if I just let my dividends reinvest, I just let share price grow, I let the machine compound, what happens? At the end of year 17, my $166.87 it turns into $857.34, or a total return, a total increase of 414%. How is this possible? Well, what happens in year 17 is I don't have one share anymore. I have 1.74 shares. If I take 1.74 and I multiply by the share price, which in year 17 should be $492.63, well, the total value of what's been created is $857.34, or a total return of 414% with all of the dividends reinvested. And so the purpose of what I'm showing here, honestly, up to this point, doesn't even answer Drifter's question, but it sets the background. And what it shows is the miracle of dividend investing. It shows how dividends can become massive over time with dividend reinvestment and with picking great stocks like 3M that are of top quality, that grow the dividend consistently. And what it also shows is something I don't discuss here on my channel too much, but a total returns basis. On a total returns basis, quite frankly, dividend growth investing rivals a lot of stuff out there. People think tech investing is the only way to get total returns. No, if you look at dividend investing, with dividends reinvested, total returns are incredible. Now, keep in mind, I am doing this example without taking taxes into account, and surely that would affect the returns here. But to keep things simple, no taxes involved. I'm saying that because I get that question every time. By the way, I know I'm going into the weeds here in this video, and that this is technical, but what I want to illustrate is we're not just here on this channel kind of screwing around trying to create some dinky dividend portfolio and watch videos to feel good. No, this is thug life investing all day, every day. And in my opinion, you got to get into the technical stuff. You got to get comfortable with Excel. You got to get comfortable with the model. I hope you're following along at home. But what I'm trying to do here is create a community, if you will, 60,000 of us strong. Maybe this community could be a lot bigger if I didn't do my really long videos with all this technical stuff. But quite frankly, I'm speaking to the people here who want to be here and want to sit through the technical stuff, because there's a notion of quality here. Not only do I invest in quality dividend stocks like 3M, but I'm trying to build a quality community here. And if the subscriber base is not the biggest on YouTube, so be it, because I want the subscriber base here to be pure quality. Quite frankly, this is a channel where I hope people watching aspire to be multi-millionaires. And so if one's goal is to become a multi-millionaire, in my opinion, going through all the technical stuff is well worth the investment. And so, also, by the way, if you're at home, check out my Excel and just point stuff out. Maybe there's stuff in there. I'm always looking to improve myself. I stay humble. So this is the background. This is the miracle of dividend investing. Now, to answer Drifter's question, I am going to go ahead and show something else on the screen right now. And this is a model that builds on top of what I just showed you, because again, I believe that the 3M example is representative of what is possible with a diversified portfolio of dividend stocks, especially stocks like 3M, AbbVie, Altria, those types of ones that have the best of both worlds, high-ish yields and high-ish dividend growth rates. And so with the second screenshot, what I'm showing you now is this notion of 17 tranches. What I know of Drifter's dad is he has 50,000 to invest per year. Nice, strong sum of money. That's a good amount of money. And so what he's doing each year for 17 years, he is going to buy future cash flow. And the way he's going to do that is he's going to buy a portfolio of dividend stocks. And so what I've done here is I've created 17 tranches, because there's 17 buy orders, 17 tranches. I'm just assuming he deploys the 50,000 in one tranche each year. Obviously, he'll probably dollar cost average, but I'm just trying to keep it simple here. So 17 tranches of 50,000. And the first thing you see is the 17th tranche. The 17th tranche corresponds to my year one data. Remember, from the prior screenshot, year one of 3M, what is the yield on cost? It's a 3.52%. And Why is it the lowest yield on cost? Because it's the first year. There's the least amount of time for the compounding miracle to happen. And so what will happen with Drifter's dad is if he does this strategy for 17 years, in year 17, it'll have the least amount of time to compound because it's the 17th year. And so basically, that's why tranche 17 is the first thing I'm listing here. But basically what happens is that 50K will buy 101 shares of 3M, and it'll be yielding roughly 1761 in dividend income per year, or again, 3.52% yield on cost. But what I do here and what's so exciting now, actually, before I even get to that, just in terms of a disclaimer here, I got to say it because I'm using a specific example here. I don't know if it's even real or hypothetical because this is just a subscriber, Drifter, asking for, hypothetically about his dad. I just want to say today's video, it's not investment advice. I'm not giving investment advice to Drifter or his dad or anyone else for that matter. Quite frankly, I'm just using this question because it's a good question and I want to use it hypothetically just to run a scenario. That's all. And so I got to say that again because I keep referencing Drifter and his dad. Again, this is not investment advice for them or for anyone else, but it is a great hypothetical case study just to share with the community and to surface with the community to get everyone's feedback to chime in on it. And so anyways, that was the 17th tranche, but tranche 16, what happens there? Tranche 16 is... It's 50,000, but it has 2 years. It has 2 years to compound, and because of the miracle of compounding, the yield on cost of that tranche, as we know from the prior model, is a 3.9. And so 3.9% multiplied by 50,000, that one generates dividend income of 1951. And I just keep going, so on and so forth. The 15th tranche, it has 3 years to compound. It's the 15th tranche of 50,000. In this hypothetical scenario, the investor deploys this in year 15. Well, we know after 17 years, this hypothetical investor is going to retire. And so again, 15th tranche only has 3 years to compound. And so what happens with 3 years of compounding? The opportunity for yield on cost is roughly 4.32%. And so 4.32% multiplied by 50,000 gives us 2161 in dividend income per year. And so you see, I keep going reverse here. The numbers are in reverse. I go from tranche 17 down to tranche 1. Why is tranche 1 listed last? Because this is the one that is 17 years to compound. This is the one that, look, if I hypothetically were starting on my retirement journey today and I want to retire after 17 years, the tranche I deploy first has the most amount of time to compound. And so the tranche deployed first, the miracle of compound interest works the most. And so with this one, the yield on cost is 18.1%. We know that's the highest yield on cost out of any of these. So tranche 1, it actually gets the most cash flow for the investor, $9,000 of cash flow. And so one of the key takeaways here, quite frankly, is anyone on their retirement journey with dividend stocks, the quicker the money can get in, the better. And so people wonder, Ian, why do you buy StarBucks so much? And sometimes you're overpaying. Maybe I'm overpaying, but I'm not overpaying for my future self in 30 years. The sooner I get my money in, the more it compounds. It just is what it is. And so, yeah, I like to buy when it's cheaper, but also my journey has so many years ahead, and my journey is not only about me, it's about my kids and future generations. And so I just want the money to compound. And the mathematical formula right here shows that tranche 1, the one deployed to first, is typically going to yield the most passive income. And so that's why for any investor just sitting around waiting, so many people sit around, they wait for the crash, they wait for this or that, and they never get started. And the problem with never getting started is the miracle of the reinvestment, the miracle of the compound interest. The machine just doesn't get going for them. And so again, that's why tranche 1 is listed last here, because it's the one that was deployed first, has the most years to compound. When you see my Excel formula in front of you with all of these screenshots on the same page, you'll see how they all interact. It's kind of like a Frankenstein model in a way that it's not very clean, but it does the job. It does the job. And so basically what you want to keep in mind on this screenshot, 17 tranches deployed over the course of 17 years. Each tranche generates a different amount of passive income at the end of year 17, and that's because they're all deployed at different points in time. The assumption here, again, is that 3M and the model just shared is representative of what's possible now and in the future with dividend investing. I think it's a reasonably fair assumption. And so, especially because the market's rallied, I'm not starting with 3M back in March. I'm starting with 3M right now in June, where it's probably fairly priced, given everything that's going on. And so 17 streams of passive income. The one deployed first generates the most. The one deployed last generates the least, but they all have merit. They all have value. And when I add them all up together, what happens is there's $76,739 of dividend income. And that averages out to a yield on cost of about 9% after the 17 years. And dollar value of the portfolio, by the way, is up to over $2 million. And so the investor invests $850,000 over these years, that becomes $2 million. But again, portfolio value shouldn't matter so much for a dividend investor, because dividend investor like myself never plans to sell the goose that lays the golden egg, or if you will, the tree with all the fruit. You don't want to cut down the tree. You want to harvest the fruit or the dividends. And so that's that. And so again, this screenshot shows $850,000 invested, possibly get about $76,000, $77,000 of dividend income after the 17 years, and the yield on cost averages out to 9%. The question becomes, hey, for this hypothetical scenario, is this what the retiree was making? And so again, going back to the question was, hey, would this work? I just don't know, because I can't comment on someone's specific situation, and I don't know about that investor's specific situation. But hey, assuming that investor was earning an earned income of this amount or less, well, hey, yeah, the dividends could theoretically cover living expenses. Now, keep in mind, though, dividends, there's going to be a tax consequence as well. And so you have to compare after-tax earnings from active income versus after-tax earnings from dividends. Generally, at this level, at the $76,000 a year dividend level, and if there's no other sources of income, the taxes should be quite favorable in a fully taxed account for someone in that situation. And so again, there's a lot of specific nuances, but this gives a flavor of what's possible. Now, here's where it gets interesting. First 17 years, dividends are reinvesting, so the snowball builds really darn quickly. But it doesn't just stop. After these 17 years, does this investor have $76,000 a year, $77,000 a year to live off of in perpetuity? No, it keeps growing. Why does it keep growing? Even though hypothetically this investor, say they do retire after these 17 years and start using up all the income to live off of, it does not stop, because even though the investor does not reinvest dividends anymore after year 17, the dividend still increases because world-class quality dividend companies like 3M continue to perpetually increase dividends over time. And again, I would never suggest for this hypothetical scenario to just have a portfolio of 3M, but again, it's a barometer, if you will, of what is possible. But in a well-diversified portfolio of 3M-like stocks, in perpetuity, dividends should grow. And so check this out. I'm going to share another screenshot. This is the third one. And in this screenshot, what you see is what happens in year 18 and so on. And so total amount of money invested stays the same at this point. It's $850,000, never a penny more. But dollar value of the portfolio keeps growing because the stock prices keep appreciating, or in this case, 3M keeps appreciating at 7% per year. Share count stays the same, but the dividend income also keeps going up, and it keeps going up because there's an assumption of that 7% growth. And so in year 18, dividend income is 82,000, 19, 20, 21. It just keeps going up and up and up. And so what's great is for a retiree, this is why I love dividend stocks so much. Yeah, the dividend income doesn't grow as much once someone retires, but it keeps growing, and it keeps growing because companies continue to raise their dividends over time. And what's so exciting is the portfolio value keeps growing. And in a horrible situation, I would never want to do this, but let's say there is a dire need for immediate money and a lot of it. Hey, there always is that equity to tap into if someone needs to tap into the equity. So again, question was asked hypothetically, if someone invests $50,000 a year in dividend stocks towards retirement, what's possible? Could it provide a reliable retirement? Well, in my opinion, it could provide, after 17 years, about $76,000, $77,000 a year in dividend income. And at home, you'll have to look at it yourself. You'll have to say, well, is that enough for me to live off of? And if it's not, obviously, more years could be invested. More years of compounding will work a lot of miracles. More money could be deployed. A different stock could be picked, quite frankly. I picked 3M, which is kind of a conservative one. Maybe a little more risk could be taken. I'd say an AbbVie or Altria type selection might carry a little more risk, but it might get the investor a little bit further. And so there's those types of things that need to be factored into. And then you start thinking also just, hey, look at reality. It won't cover expenses. And then you have to start thinking, well, how could expenses be cut? Could someone play geo arbitrage, either internationally or even domestically? There's all those types of considerations that have to be incorporated into someone's situation. But the reason I'm showing this, again, is this is how it's possible to completely live off of dividends. It's not easy. Obviously, saving $50,000 a year, it's a lot of money. It's not easy. And, but it's possible. And what I also want to share here is, don't feel discouraged if you're not saving $50,000 a year. Everyone has to start somewhere. And what this does show is the sooner the better. The compounding machine is powerful. The time is powerful. And so maybe someone has more than 18 years. If they do, man, that allows the miracle to work even better. And so, that's why I love dividends. Dividends are for everyone. Everyone has a unique situation. And many people, they may be able to live off of less than $77,000 a year, in which case, hey, less money needs to be deployed. And many people may not want a full retirement. They may want to work part-time, or they may want to, hey, think about it, do some YouTube videos for a few hours a week, or it's never a few hours a week, I guess maybe 10, 20 hours a week, but it's not a full-time job. And in addition to doing that, get some dividend income. And so there's kind of those shades of gray where it's a semi-retirement. It's kind of pursuing a passion project supplemented by dividends, and all of that can be fueled by dividends. So don't get discouraged if you're not saving or investing $50,000 a year, because many people will not need that much to retire, and others may not want a full retirement. They may want to kind of work a little bit and retire, and yet others may have other sources of income, such as pensions or 401ks, other means of acquiring a retirement nest egg. So thank you for the question, Drifter. I love this one. Again, this is not financial advice, but I love the question, so I had to answer it. It's a great hypothetical for the community to see. Check out my model. Let me know what you think about that. So that's segment number 1. Segment 2 in today's video, I'm going to hop into it next. I actually filmed this earlier today. Boy, it's been a long day. I'm telling you, hard work, everyone. That is, that's the way to success. And there's no shortcuts. Dividend investing, it's get rich slowly, and it's get rich with a lot of hard work up front, but it starts paying off hugely in the end. And so that's why I work so hard, and I do it because I love it. But I'm going to hop into segment 2. You'll see a day in my life. Let me know what you think about my life. Love you all. I'll see you again, though, at the end of the video today. Hey, everyone. I am here in my car for a day in the life of PPC Ian. This is a popular request from many of you, and I thought I would do it to celebrate 60,000 dividend investors strong. And so it's just after 9 a.m. I'm in my car, and I'm going to share my day today with all of you. Now, this is going to be one of my more exciting days because recently, with all this shelter in place, literally I'm just stuck at home and working behind the computer most of the day, going out for runs, sometimes walking to Starbucks to get a cup of coffee and a snack, but it's been pretty boring, and honestly, I am getting tired of the shelter in place. It's been taking a while here in the Bay Area to get back to normal, but I'm on the road today, and many of you know I actually, by trade, by profession, I am a real estate developer, a commercial real estate developer, and so it's just after 9 a.m. I'm in the car, headed out to the job site, and I have been working on this particular project for a number of years right now. It is my baby. Headed out to it to check out on how it's going, and it's exciting. It's a self-storage facility that I'm building, and one of the things I'm looking forward to checking up on today is the elevator that's being installed, and it just so happens to be an Otis Elevator. So hopefully when I'm out there, I'll get some photographs, maybe some video footage of that elevator, so all of you can see my brand new Otis Elevator. This is a contract that I negotiated and I'm proud of, and I feel really excited about because I'm a shareholder in Otis. I own Otis because it was spun off of United Technologies when United Tech merged with Raytheon to create Raytheon Technologies, and so now I own Raytheon Technologies, Otis, and also Carrier, which was another spinoff. And so I'm so excited about that, to see how that elevator is going and just check in on the project and, quite frankly, get out of the house, make the day a little bit different today, be in the car, just get out there in the field, if you will. I feel that that is a successful way to approach business, is not just to be behind the desk every day, but to get in the field. And I feel that that's a successful way also just to approach investing, see how things are going. Check out Starbucks. How's the line there? Check out some of my positions. Hey, I own a lot of the brand names that I drive by. Hey, are there any Pepsi or Coca-Cola trucks out there? I always like to be in the field just to see how things are going. Now, Starbucks, you're going to be maybe a little upset at me right now, but I made my first pit stop here just right near Costco, and I don't own Costco, but I'm celebrating Costco here with my Costco coffee. This is the cold brew coffee from Costco that I brought from home, and I'm right near a Starbucks though as well. So sorry, Starbucks. Today Costco got my business. It's just cheaper. But because I'm doing all the Costco coffee, I had the money to buy more shares of Starbucks yesterday. Every Monday I've made it a tradition buying more shares of Starbucks, and so that has been exciting. And so hang in here with me, ride with me, if you will, like my man Nelly. I'm going to make a few stops along the way, just share what's going on in my life. Let's make today exciting. Follow along, see what I'm up to, and I'll catch you in the next clip. All right, everyone, back in the car. Just spent a few hours on the job site, and I just grabbed a quick bite to eat in the car. I just had a snack plate and a water. I'll tell you, these days for lunch, that's often what I do, a quick lunch on the go, a quick lunch at my desk while I am working. I try to avoid taking a lengthy lunch or going to a restaurant. I reserve that for a special occasion, like a date lunch with my wife. And the reason for that is just to optimize my time. There is such limited time, and as someone who is striving for success in life, in so many arenas of life, I have to cherish my time, I have to respect it, I have to conserve it, and one way I conserve it is by taking these quicker lunches. And so that's something that I used to not do all the time. I used to take the longer lunches back in the day, and I found just as I get older, it's just a time-saving hack. And it's one of the reasons that I enjoy investing for dividends so much, is one day those dividends will buy back all of my time. But until then, I am on the grind, I am on the hustle, I am out there hustling all the time, and I got to conserve my time. And so While I'm taking a break here after grabbing that quick bite, about to go, I want to address 2 subscriber questions. And one of those questions was about the stocks that I invest in during these unprecedented times, not only of the pandemic, but also of the Black Lives Matter movement. And so I want to discuss that. Someone was asking me, Ian, do you are you changing your stock selection? Are you navigating these difficult times, these unprecedented times, as an investor any differently than you were before? And a lot of you who follow me on Instagram or Twitter, you see that I do. Or even those of you who have been following all of my videos, I am a numbers guy. I'm a computer science major. I invest and do some of the most extensive fundamental analysis possible before I get into a company. But once I'm in a company, there also is that emotional side of investing, and I like to feel attachment. Those brands that I feel are doing the right things from a value standpoint, from a society standpoint, I feel like they're setting themselves up for success. Their stakeholders, their shareholders, their customers, those are the companies that I double down in. And I'll tell you, Starbucks, for example, I bought really low, but I've been averaging all the way up, and I buy every Monday. And one of the reasons is I feel what they're doing right now by treating their employees so well, by treating their customers so well, their communities so well. I like it. I like what I see, and that's one of the reasons that I am putting even more money in Starbucks than I was before, because not only are the fundamentals amazing, not only is the technology amazing that the company has, not only are the long-term prospects amazing, but they're doing the right thing. They're out there doing the right thing, and so I'm getting behind Starbucks. And I'll tell you, another one is McDonald's. I feel like McDonald's has been doing a great job serving our communities during the pandemic. I feel that McDonald's has taken a good stance, a strong stance on the Black Lives Matter movement, and I feel like they are doing some of the right things out there. And so McDonald's is another one that I continue to buy. I continue to average up. Is it a bargain right now? Is Starbucks? No, neither of them are a bargain, but I discussed this in my last video, which I'll link to in the description below. I'm not so concerned about bargains right now. I am just continuing to average in small tranches, because my time horizon is forever, and I certainly would rather have my money in Starbucks and McDonald's than fiat currency. That, in my opinion, will erode in value over time. As I discussed in my last video, I'd rather own operating businesses that have pricing power, that own real estate. McDonald's is one of the best real estate plays of all time. And so I want to actually discuss a hot button topic right now. And I don't think I'm the person, quite frankly, that even has anywhere to kind of discuss this, because I am not black, but I want to discuss Black Lives Matter because I put a post on my Instagram and also on my private Facebook group, and I noticed after placing the post there was a lot of outpour of support, and I thought that was wonderful. But there were also some negativity, especially on my Facebook group, and some people actually left the group. And so I want to take this opportunity first just to share with you what I posted. It's just a beautiful graphic that was created by my friend Bernie. Thank you, Bernie, for creating this graphic. And he created it for me. I came up with the concept, and it is a tribute to my heroes who happen to be black. Most of the heroes that I have actually are black, and they inspire me each and every day. And so I was thinking about that, and it just got me thinking, like, you know, I don't know the first thing about the Black Lives Matter movement, but what I do know is that I believe that people of all races should be treated fairly and equally, and that our society should be based on merit, not based on the color of your skin or your heritage. It should be based on you as a person and what you bring to the table and your value. And all I know is that many of my mentors, most of my mentors, my heroes, some of the people or the people listed in this graphic, they are all black. And so I owe a lot to the black community for encouraging me, supporting me, and being my hero. And I just posted this on social media that I believe all Black Lives Matter, and there was some backlash. And so I want to take that opportunity here, as long as I'm doing the vlog style thing. Maybe this doesn't pertain to dividend investing as much, but I think it's important actually, because the purpose of this channel is this is dividend investing for everyone. And when I say everyone, I mean everyone, different age groups, different ethnicities, people from all around the world. dividends unite all of us. We are all passionate here about dividends. And so what I just want to be quick to acknowledge is that just because I am acknowledging that Black Lives Matter and I'm supporting Black lives is because the Black community needs our assistance right now. They need our support. They need our help. And that does not mean that I don't believe other lives matter, that other ethnicities or even other types of people like police officers, for example. I support police officers as well. And I know we have a lot of them in this community here who have reached out to me over the years. And I love you all and thank you for keeping our streets safe and prosperous. And so I respect all different people, but the reason that I am supporting Black Lives Matter right now is I believe that Black people should have the same rights as everyone else, and that they should be able to walk in the streets without fearing for their lives, and that there should be opportunity for all. And that's what this community is about. And I just want to make it really clear that there will be no racism in this community at all. None at all. And so some people were saying, like on my Facebook group, like Ian, these very people who you're trying to support are destroying the community, or they're going to come after you, this or that. That's just flat out wrong. And I just want to be really clear here that some of those people said, I'm going to leave your Facebook group. Hey, please do. Please. I just don't want that type of racism around. And so if you're going to be racist, just please, it's okay. Move on. Find another community. It's just, there's going to be no place for racism here on my community. Put the prejudice aside. Remember that this is dividend investing for everyone. We're all united by dividends. I try to keep my political beliefs out of here, and I'm not trying to make a political statement one way or the other. I'll tell you flat out, I am a registered Republican. I'm really kind of in the middle of things, though. I honestly am more, I would say, of an independent type person politically. I don't really align with any of the parties. Politically speaking, it's just hard. It's hard. It's hard to get behind politics for me in general. Easy for me to get behind dividends. But anyways, the reason I spoke up is I felt compelled to do so. I want to support my Black brothers and sisters out there. I love you all because they need my support right now. And my Black heroes, they've been here with me my whole life. Anyways, I'm going to sign out now. On to the road again. I'll see you in the next clip. Love you all. Hope I didn't create even more drama here, but wanted to explain that real quick. Love you all. I'll see you in the next one. Hey everyone, guess what time it is? It is Starbucks o'clock. And so I decided on the way home here to take a stop at this park, beautiful park at the Lagoon in Foster City. Shout out to all my local Bay Area crew. We had a meetup here back when we were allowed to do those. Hopefully we're allowed to have dividend investing meetups again. But I decided to stop at the park here because I'm working on my book. A lot of you have been asking. I'm writing a book about dividend stock investing. It's not just going to be some other book, hey, how do dividends work? Hey, what's a dividend? This and that, all of that stuff, it has been written before. I am writing, in my opinion, one of the best books on dividend investing ever. It is going to be about 50 chapters, and each of these chapters is very involved. So I'm working very hard. It's hard to focus on the book when I am at home, and so it's going to be a lot better to work on it right here in the park before I go home. So I'm going to enjoy my Starbucks beverage, work on my book. And guess what? When I go home later tonight, I'm going to film the whole first part of this video as well. And so I guess Thug Lifestyle, Thug Life Investor, the work does not end. And that's why I'm powered by so much coffee. But it's going to be a late night tonight. But I'll have this video ready for all of you tomorrow. Love you all. I'll see you in the next segment, which is going to be the disclaimer that I film later tonight. Have a good one, everyone. Cheers. All right, so I hope you enjoyed that, the day in my life segment. And before I leave today, I just want to do my disclaimer. In terms of a disclaimer, today's video is not investment advice. It's just general information for fun and entertainment. I'm not a licensed investment advisor. Before you invest any money, please consult a licensed investment advisor first. Just sharing my personal journey here on YouTube for fun and entertainment. And today's scenario was completely hypothetical, may have mistakes, all that good stuff, may not be perfect, may not be accurate, may not hold up. Proceed with caution, especially in a stock market like this where it has rallied so darn much from the lows with our overall economy still struggling. So with that, in terms of a full disclosure, I own the stocks mentioned today. I am long 3M, ticker symbol MMM, Altria, ticker symbol MO, AbbVie, ticker symbol ABBV. What else? I am long McDonald's, ticker symbol MCD, Starbucks, ticker symbol SBUX, Raytheon Technologies, ticker symbol RTX, Otis, ticker symbol OTIS, Carrier, ticker symbol CARR, PepsiCo, ticker symbol PEP, Coca-Cola, ticker symbol KO. I own all of those in my personal dividend stock portfolio. Hey everyone, I'm working hard here for the community. If you appreciate the video, please check me out on social media. I'm on Instagram, Twitter. Please subscribe to my channel, put comments below, all that good stuff. Word of mouth marketing, and share it with your friends, your family. That means the world to me. Please check out my merch, purchase my merch. One of the great ways you can support my channel. I love you all. I'll see you in the next video.